Stop everything you're doing right now. Put down your phone, close that laptop. Tell whoever you're with that you need 10 minutes of complete silence. Because what I am about to show you is either the biggest financial scandal of 2026 or the most misunderstood story in precious metals history. And depending on which one it is, the outcome is going to change everything you think you know about the silver market. Ladies and gentlemen, the Metal Guy here. Today is January 16th, 2026. And we need to talk about a claim that's been circulating across financial media, social platforms, and precious metals forums for weeks. A claim so explosive, so potentially devastating, that if it's true, it could trigger the largest short squeeze in commodity market history. The claim is this. A major American financial institution is allegedly short over 5,900 metric tons of silver. That's approximately 190 million ounces. And at current prices, around $72 per ounce, that position is worth roughly $13.7 billion. Now, before you run to the comments and start screaming manipulation or conspiracy theory, let me be very clear about something. We're going to separate fact from fiction. We're going to look at verified data. We're going to examine regulatory filings. And we're going to figure out what's actually happening versus what's speculation. Because here's the truth. Some of this story is verified. Some of it is rumor. And some of it is being deliberately misrepresented by people with agendas on both sides. Let me show you what we know for certain. Let me show you what's speculation. And let me show you why this matters regardless of which parts are true. First, let's establish the verified facts. According to official regulatory data and multiple credible sources, here's what we can confirm. Verified fact number 1. According to the Commodity Futures Trading Commission's CFTC Commitments of Traders reports, as of December 2nd, 2025, commercial traders in the silver futures market held a net short position of approximately 212 million ounces. That's confirmed. That's public data. That's not speculation. Verified fact number 2. According to verified financial reports, a major American financial institution disclosed in mandatory regulatory filings that it has contractual obligations to deliver over 5,900 tons of silver. That disclosure exists. Multiple financial journalists have examined it. It's in public filings that anyone can access. Verified fact. 3. According to multiple market reports from late 2025 and early 2026, the same institution has been aggressively standing for physical delivery on silver futures contracts. In the first delivery report of 2026, they took maximum physical delivery, a complete reversal from their historical pattern. This is verified exchange data. It's documented in CME group delivery notices. It's real. Now, here's where it gets complicated, because these verified facts are being interpreted in completely opposite ways depending on who you ask. Let me show you interpretation number 1, the short squeeze crisis narrative. According to this interpretation, which is being promoted heavily on social media and precious metals forums, here's the story. A major bank sold 190 million ounces worth of silver contracts that they don't have the physical metal to back. They're naked short. They sold contracts expecting the price to fall, planning to buy them back cheaper and pocket the difference. But instead, the price went up, way up. Silver has surged from around $20 in early 2020 to over $70 in late 2025, a more than 250% increase. Now, according to this narrative, the bank is trapped. They owe 5,900 tons of silver they don't have. And with physical silver trading at massive premiums over paper prices in Asia, $130 in Japan, $106 in Kuwait, $97 in Korea, they can't acquire the metal without driving the price even higher. This narrative claims that the bank is facing a multi-billion-dollar loss, that they're underwater on their short position, that they might need a bailout, and that when the squeeze finally happens, silver could gap to $200, $300, maybe even higher, as the bank desperately tries to cover. Sounds dramatic, right? Now let me show you interpretation number 2. Interpretation number 2, the misunderstood hedge narrative. According to this interpretation, which is being promoted by financial analysts and bank defenders, here's the alternative story. The 5,900 tons of silver contracts aren't a naked short position. They're part of a complex hedging strategy involving both futures and physical holdings. According to verified reports from December 2025, the same institution that supposedly has this massive short position also holds over 750 million ounces of physical silver, the largest stockpile in the world. Between June and October 2025, according to these reports, the institution allegedly sold off its entire 200 million ounce paper short position and flipped long. They're now holding both physical and paper long positions for the first time ever. If this interpretation is correct, the 5,900 tons disclosed in regulatory filings aren't a vulnerable short position. They are delivery obligations that are fully backed by physical holdings in vaults. The aggressive standing for delivery in January 2026, That's not desperation to cover shorts. That's accumulation. That's a major institution buying as much physical silver as possible because they know what's coming. So which interpretation is correct? Let me show you the evidence for both sides. First, let's look at the evidence supporting the short squeeze crisis narrative. Evidence point number 1. According to a verified financial report, the Federal Reserve Bank of New York delivered a $17 billion emergency cash injection to an unnamed bank on December 26, 2025. This happened right as silver prices were spiking and volatility was accelerating. Financial analysts immediately speculated this was connected to silver exposure. An unnamed bank needing emergency liquidity right as silver markets are breaking? That's suspicious timing. Evidence point number 2. According to verified market data, silver lease rates, the cost to borrow physical silver, spiked to 200% in late 2025, from 0.25% to 200%. That's not a normal market. That's a shortage. That's desperation. And according to verified reports, a major institution had to lease 4,000 tons of silver from a large Chinese bank in late 2025. They had to borrow physical metal urgently. Why would they need to borrow if they already have 750 million ounces? Evidence. Point number 3. According to regulatory history, the same institution paid nearly $1 billion in fines for silver market manipulation in previous years. They've been caught manipulating silver prices before. They've admitted to spoofing. They've settled with regulators. Given that history, is it really crazy to suspect they might still be playing the same game? Now let's look at the evidence supporting the misunderstood hedge narrative. Evidence point number 1. According to verified stock market data, the major institution in question closed at $334.61 per share on January 6, 2026, just shy of its 52-week high of $337.25. The company reported trailing 12-month net income of $56.66 billion, with total assets exceeding $4 trillion and a market cap of $920 billion. Does that look like a company facing insolvency from silver exposure? Markets don't whisper about these things. If a major bank was truly on the verge of collapse from a bad derivatives position, their stock wouldn't be at all-time highs. Evidence point number 2. According to verified reports from multiple credible sources, the institution holds over 750 million ounces of physical silver in vaults. Oh, that's confirmed. That's real. If they're sitting on 750 million ounces of physical metal, how can they simultaneously be fatally exposed to a 190 million ounce short position? Evidence point. 3. According to the leading analyst who has tracked this institution's silver positions for years, all reports about them closing their short position are speculation. The CFTC doesn't report specific bank positions. No one knows for certain if any individual bank is buying or selling. Everything circulating online is educated guessing based on patterns in aggregate data. It's not confirmed fact. So here's where we are. We have verified facts that both sides agree on. Commercial traders are net short 212 million ounces, CFTC data. A major institution disclosed 5,900 tons of delivery obligations, regulatory filing. The same institution holds 750 million ounces of physical silver, verified reports. Silver lease rates spiked to 200%, market data. The NY Fed injected $17 billion into an unnamed bank in late December, verified. The institution is aggressively taking physical delivery in January 2026, CME data. But we have completely opposite interpretations of what those facts mean. Interpretation number 1 says they're trapped in a massive naked short, desperately trying to cover and about to implode. Interpretation number 2 says they're fully hedged, accumulating physical, and positioned to profit from the coming silver explosion. Now, let me tell you what I think is actually happening, because I believe the truth is somewhere in between. Here's my analysis based on all the verified data. The major institution was historically short silver. That's documented. They manipulated markets. That's proven through fines and settlements. But starting in mid-2025, they saw what was coming. They saw the structural deficit. They saw the export restrictions from major producing nations. They saw industrial demand exploding. They saw the vault inventories draining. So they flipped. Between June and October 2025, they covered their paper shorts and started accumulating physical. They built the largest silver stockpile in the world, 750 million ounces. But here's the problem. They couldn't close all their derivative obligations. Some contracts are long dated. Some commitments are embedded in complex structured products. Some positions can't be unwound without triggering a market panic. So they're stuck with 5,900 tons of delivery obligations, roughly 190 million ounces, that they need to fulfill. And while they have 750 million ounces of physical silver, not all of that is freely tradable. Some is allocated to other commitments. Some is pledged as collateral, some is tied up in vaults that can't be easily accessed. This is why they're aggressively standing for delivery in January 2026. They need more physical metal to meet their obligations. They're hoarding. They're accumulating. Not because they're about to collapse, but because they're preparing for the squeeze. And here's the kicker. If I'm right, this is actually bullish for silver. Because if a major institution with $4 trillion in assets is aggressively accumulating physical silver, if they're standing for maximum delivery, if they're hoarding metal despite already having the world's largest stockpile, that tells you they know the price is going way higher. Now, let me show you why this matters, regardless of which interpretation is correct. Scenario 1, the institution is trapped and about to collapse. If this is true, when they finally get margin called and forced to cover their shorts, they have to buy 190 million ounces in a market where registered inventory is only 127 million ounces. That's mathematically impossible without the price gapping violently higher. We're talking $150, $200, maybe $300 per ounce, as they desperately bid for metal that doesn't exist. Scenario 2. The institution is fully hedged and accumulating because they know the price is going to $100, $50, $200. They're not accumulating for fun. They're accumulating because their internal models show massive upside. And when the largest and most sophisticated silver trader on the planet is aggressively buying physical, that's a signal to everyone else that the real move is just beginning. Either way, collapse or accumulation, the outcome for silver prices is the same. The price goes way higher. Now let me address the bailout question. Because people are asking, if the major institution is in trouble, will the government bail them out? Here's my answer based on 2008 precedent. Yes, probably. They claim they were forced to take it under federal rules, but the point is, when systemically important banks face solvency threats, the government steps in. If silver exposure threatens a $4 trillion bank, the Federal Reserve will provide liquidity. We already saw a $17 billion cash injection in late December. But here's the thing. A bailout doesn't stop the silver price from going up. It might delay it. It might smooth out the volatility. The government can print dollars to bail out banks. So let me tell you exactly what you need to do right now. Whether the major institution is trapped or accumulating, the direction is the same, up. If you own paper silver, understand your counterparty risk. Some ETFs are backed by physical, some use derivatives, some are custodied by the same institutions that might have these massive positions. Do you know which category your holdings fall into? Do you trust the counterparty? If you don't own any silver yet, this is your window. But physical is trading at $97 in Korea, $106 in Kuwait, $130 in Japan. That disconnect won't last forever. When the paper market breaks, when the institutional positions blow up, or when they accumulate everything available, the paper price will snap to match the physical price. Buy now at $72 before it catches up to $130. According to verified reports from early January 2026, when physical silver in Japan and the Middle East was trading at $130, while Western screens showed $71. A major financial institution's stock hit all-time highs. If they were truly facing a catastrophic short squeeze, their stock would be crashing. But it's not. It's at record levels. They're positioned. They're prepared. The $13.7 billion silver position isn't a trap that's about to destroy them, but for the rest of the market, for retail investors, for industrial buyers, for governments that need silver, it's a warning. It's a signal that the largest and most sophisticated players are aggressively accumulating physical metal. Here's my final message to you. The $13.7 billion silver position is real. The 5,900 tons of contractual obligations are documented in regulatory filings. The 750 million ounces of physical holdings are verified by multiple sources. What is not clear is whether this represents a vulnerable short position about to explode or a strategic accumulation position that's fully hedged. But here's what we know for certain. Whether they're trapped or positioned, whether they're about to collapse or about to profit, the outcome for silver prices is the same. The structural deficit is real. The industrial demand is exploding. The paper-physical disconnect is widening. And the largest silver position on the planet, whether it's a 13.7 billion short or a 750 million ounce long, is telling you the same thing. The price is going way higher. They also reportedly hold 750 million ounces of physical silver trapped or positioned. But the verified data shows silver is trading at $130 in Japan, while Western screens show $72. Vault inventories are at decade lows. The structural deficit is 230 million ounces. And the largest players in the market are aggressively accumulating physical metal. Whether the institution is about to collapse or about to profit, the signal is the same. Get into physical silver. Get out of paper exposure before the disconnect becomes permanent, before the squeeze happens, before $72 becomes $130. This is the metal guy. Remember to like, subscribe, and share. The $13.7 billion position is real. The price disconnect is real. Do it now.